Greetings from Columbia Business School, Executive Education. I'm Scott Gardner, and I'm here today with Professor Angela Lee for today's webinar, Launching Your Career in Venture Capital. Before I introduce Angela, I'd like to just go over a few quick logistics. As you'll see on the next slide, a recording of this webinar will be sent to you. If you'd like to tweet about this webinar, please do so at #CBSExecEd. And finally, please submit those questions to the Q&A box. We'll get to as many of those as possible in the last part of the webinar. It's my pleasure to introduce Professor Angela Lee. She is the award-winning professor and former Chief Innovation Officer at Columbia Business School, where she teaches venture capital and leadership courses. She has started her career in product management and then moved to consulting at McKinsey. She created 4 startups and was also the founder of 37 Angels, an investing network that has evaluated over 15,000 startups. She also serves as a venture partner at Fresco Capital, an early stage venture fund that focuses on the future of work, digital health, and sustainability. She has spoken at the White House and NASA and is sought after expert on CNBC, Bloomberg TV, MSNBC, and Fox Business. She was recognized by Inc. as one of 17 inspiring women to watch, by Entrepreneur Magazine as one of 6 innovative women to watch, and by Crain's as notable woman in tech. In 2020, she was awarded the Dean's Award for Teaching Excellence at Columbia Business School. She is the faculty director of the upcoming Venture Capital Program, running October 8th through the 22nd, and our new executive education program, Building Your Venture Capital Investment Thesis, November 8th through the 11th, both live online this fall. Professor, it is great to be with you today. I will leave the stage and I'll rejoin you at the end of the webinar.
Scott, thank you so much for that lovely intro, and good morning, good afternoon, and good evening, everybody. I hope that you are all well, and today we're going to talk a little bit about launching your career in venture capital, and I wanted to try to answer 3 questions. The 3 questions I wanted to answer is, if you're thinking about putting money into this space or kind of dipping your toe into the water, what are things that you want to answer for yourself before you start to invest? The second question is, given the wide space that is venture capital, how do you pick an area to focus on? And then finally, how do you get your foot in the door, which a lot of you had questions that you sent in beforehand, so thank you for that. There will definitely be time for Q&A at the end, so definitely put them into the Q&A window, and let's dive in. So in terms of before you start to invest, I think it's really important to go in eyes wide open. So the first thing I want to make sure is that we all know the difference between a venture capitalist and an angel investor. I realize this might be basic for some, but not everybody knows the difference between these 2 terms. So the way that venture capital works is that if I'm a general partner of a fund, I'm going to raise money from a bunch of limited partners or LPs. So if I have 100 limited partners, they each give me $1 million to invest. I am a GP managing a $100 million fund, and I am making investment decisions on behalf of my LPs. Contrast that with angel investing, where it is individuals, angels, making their own investment decisions and investing their own capital. What that typically means is that VCs are going to be able to write larger checks, right? Because most of us don't have $10 million or $10 billion, my apologies, to invest the way an Andreessen or a Sequoia would. It also means that angels have a little bit more latitude in what they invest in because they don't have fiduciary responsibility to their investors. They also get compensated very differently. VCs get paid off of fees and carry. You will often hear 2 and 20. What does that mean? It means that if I'm running a $100 million fund, every year I get paid 2% in fees, and then whatever money I make, I get to keep 20% of that in carry. So if I turn $100 million into $200 million, meaning I make $100 million in gains, I as the GP keep 20 million and then I distribute 80 million to my LPs. 2 and 20 is pretty typical in the industry. The way angel networks work is that you typically are charging your members dues. In New York City, it might be between $3,000 and $5,000 per year, and that does change a little bit geographically. On the venture capital side, you have the standalones and you have the corporates. The standalones are the ones you've all heard of: Bessemer, Kleiner, Andreessen Horowitz. And corporate venture right now is 20% of venture capital. So Google Ventures, Samsung Ventures, Apple Ventures, and it is a pretty substantial part of venture capital. On the angel side, you have solo angels who are working independently and looking at companies. And then you have angel networks, where it's a group of people coming together to share deal flow, to diligence together, and then also thinking about what they invest in. Now, if you are thinking about putting money into this asset class, it's really important to think about how much control you want to have. And it is a little bit of a spectrum. So the least amount of control you have over your investments would be to be an LP in a fund. And in that case, you as an LP are trusting that GP to make investment decisions, so you have very little control over your investments. You could then join an angel fund where a group of angels pool together and there's some voting mechanisms. So there's archangels, for example, ARC angels, where I believe it was 70 investors, each putting in $50,000 into a fund. They now have a $3.5 million fund, but they're making decisions as a collective. There's some sort of voting mechanism. Most angel networks, the way they work is that the deal curation happens from the team, and then angels collectively diligence, but they get autonomy over what they invest in. So for 37 angels, we look at about 2,500 companies a year. We introduce the best 50 to our angels, and then our angels independently decide on the 10 or so they want to invest in per year. Or you could be a solo angel, right? So I was a solo angel from 2008 to 2012. And in that case, I was looking at a couple hundred deals a year, maybe investing in one or two. And so that spectrum, there's no right or wrong place, but you have to ask yourself, how much control do I want to have? And the control tends to be directly opposite of diversification, right? So as an LP in a fund, you tend to have a lot of diversification, a little bit of control. Whereas as an angel, you have a lot of control, but not very much diversification. So it's kind of, that's the balancing act that you're trying to play. You also have to ask yourself if you're comfortable with the risks. I think a lot of us join angel investing or venture capital because we're excited about the rewards, right? We want to make a ton of money. We want to be a part of this really cool network. It's really fun to learn about these things. And many of us, myself included, were former founders who have now kind of crossed the chasm over to become an investor, and we want to maybe mentor and help investors learn off of some of our mistakes. That said, we have to talk about the risks. So obviously this is a very risky asset class. Just to give you a sense, our goal is to triple our money in 10 years. That's the goal. But half of all VCs do not return their LPs money. What that means is, as an LP, I give a GP $1 million to invest. And then 10 years later, they only return $700,000. Half of all VCs are actually losing their LPs money. It's also not particularly liquid. From seed to exit right now is taking about 8 years. It's not particularly diversified because the check sizes are large. You don't have a lot of legal control over what the company does, and it's emotional in a way that investing in the public markets is not. In terms of picking an area to focus on, most people tend to think about their expertise first. That's fine. I would also encourage you to think about what you're interested in and also where your network is. To be a good investor, you are consuming a lot of content, you're meeting a lot of founders, you're going to conferences. If you're not interested in that topic, it's going to be a very difficult few years for you. So I strongly encourage you to pick an area that's interesting to you. And then think about where your network lies. Where can you, a lot of our job as investors is to add value post-investment. And so the more you are able to introduce them to hires, to other investors, to partners, the better. And folks tend to think about these areas when they're specializing. So what stage do you want to be a seed investor, a Series B investor, or a Series D investor? What sector, fintech, ed tech, prop tech? Is there a type of founder you want to focus on? There are a lot of funds focused on, for example, diversity and inclusion, and then geography, both where do you want to be traveling? Where's your company is going to be located? People tend to pick within these areas. My strong advice to you, if you are thinking about going a little bit deeper into the space and learning, is to start to develop a point of view. So most of us are reading a ton of articles every day. We're consuming a bunch of content, and a lot of us are hearing pitches, right? We're going to demo days. We're hearing our friends pitch. And we're hearing all these pitches. And both of these activities are relatively passive. And so what I would encourage you to do, if you're serious about entering into the space, is to move into a place where you are creating content. So if you read 17 articles about prop tech and what's happening to the future of real estate, that's great. But force yourself to write a half-a-page summary about it. You don't have to publish it. I mean, it's great if you publish it into a Medium article or a LinkedIn article, you tweet about it. But even if you don't do that, even if it's just for yourself, do a little half-page summary. It'll force you to kind of chew that knowledge and come up with a perspective in a way that's very different than if you just passively read. I actually write a book report on every book that I ever read so that I'm forcing myself to really chew and digest that knowledge. Similarly, when you hear pitches, a lot of the times we just hear pitches, we're like, oh, that was interesting. But what I would move to is start to make decisions. So keep a little notebook and say, I just heard 10 pitches. I loved their team. I didn't like their market. I would invest, right? And then what you can do is later on, look it up on Crunchbase. Did they get funded? And that doesn't necessarily mean that you're right or wrong, but at least it gives you a sense to other investors think similar to me. And it forces you to, again, develop that perspective. In terms of places where you can get insights, these are very data-rich resources, right? So PitchBook and CV Insights are very focused on data. Halo Report is on angels, right? Because angels wear halos. And then there's a ton of content out there as well. Bessemer publishes what they call their Atlas, where they talk about their perspectives in different industries, and they call them roadmaps. So if you want to know what some really smart VCs think about the future of active aging or the future of fintech, you can go to Bessemer Atlas. TechCrunch has a bunch of articles as well. There's no shortage of content out there to read, but what I really encourage you to do is just to start jotting down notes about, I just read 6 articles. How would I put those together into some sort of point of view? And then in terms of hearing pitches, accelerators are great places to be involved. They're schools for startups where a startup will spend 3 to 6 months with an accelerator, learn how to pitch, learn how to fundraise, learn how to sell, all that kind of stuff. They all have what's called a demo day, where the 10 companies that just went through their program will pitch to a bunch of investors. It's a great place to hear pitches, and that's an option. Also, equity crowdfunding, right? Equity crowdfunding, there are literally hundreds of sites. Seed Invest happens to be one, where you can go on and say, oh, Seller Stash is this company. I can download their pitch deck, I can read it, and I can start to think through, do I like this company? Do I not like this company? You can even invest. You can see in this case, you can invest $1,000. But even without investing, you can start to be seeing pitch decks and start to develop that muscle of what you like and what you don't like. Start Engine happens to be another one. And you can see you can invest as little as $500. But again, it's really learning to assess companies. Okay, and then the final question I wanted to answer before we take questions is, how do you get your foot in the door? And I think this is something I get asked on multiple times a day, which is, how do I actually get a job in venture, become an angel investor? How do I get my foot into the door? I am a strong introvert, and so this was hard for me when I first entered the space, which is you do have to network. And yes, even in an age of lots of virtual meetings, you do have to get out there and start meeting people. And I think a lot of times people immediately think, I want to meet with investors, right? And that's great. Obviously, if you could meet with a venture capitalist that you want to work with, that's awesome. But I would really encourage you to look at the entire ecosystem, right? So are there accelerators where you can maybe mentor at? Maybe you are an amazing growth hacker, or you are really good at cryptocurrency, or you understand cybersecurity, whatever it is, and you can do in office hours and start to meet founders and meet to investors. It's a good way to kind of get in there. Service providers, lawyers, CFO outsourcing companies, payroll outsourcing companies, they're talking to a ton of founders. Corporates, again, there's a lot of activity in the corporate space around venture, universities, and obviously talking to investors. And so I would look through, your LinkedIn, your own personal Rolodex, and ask myself, who do I know who's in the space that I can start talking to, and ask them for introductions to start to get into the thick of things and start going to events. And the last thing I'll say is that most people who want to work in venture, their very first job is often not a full-time job in venture. They usually have to start with something venture adjacent. What does that mean? So venture adjacent could be, what are you doing that looks like investing? So start off being an angel investor. Maybe you can work at a corporate venture capital firm, or maybe you can start by doing equity crowdfunding. So for example, Republic, which is an equity crowdfunding site, you can invest for as little as $50. And what you can start to do is you can walk into a venture capital firm and say, what, I looked at 250 deals this year and I invested in 5. Right? And this is how they're doing. But it tells them, I've started to build that muscle of what it means to be an investor. You could also do non-investing roles. You could be a VC scout. This is a job where you are helping venture capitalists to find the next deal they're going to invest in. Sometimes they're compensated, where if the company does really well, you introduce Airbnb to them. They might compensate you. A lot of the times it's uncompensated. Corporate, mergers and acquisitions. You can work at an accelerator. VC platform is the non-investing role. So most venture capital firms have the investing team and then the platform team that supports the portfolio post investment. And that can be a great place to start as well. If you want to go to vcplatform.com, there are a ton of jobs there specifically for VC platform jobs. And then there's also working at a startup. So with that, I'm going to take some Q&A because I do see some questions percolating in the chat window. Scott, if you want to rejoin, happy to have you as well. So, okay. How can a business convey an attractive image regarding a company's image to the market? So in terms of having a good image to the market, you want to portray an awesome team, a really attractive market, and then some amount of traction. I'm actually going to stop sharing, and I'm going to throw a link in the chat window, which is a pitch deck that I like to see. And so I will share that in the chat window. Columbia team, I hope that's okay that I'm doing that. So that's a good slide deck that we like to see when people are pitching. Is it a market standard approach to provide some carry for investment managers or only for more senior roles? So partners are getting the majority of carry. Actually, I actually have a slide on this that's a little bit more specific. So in terms of carry, I'll just leave this up for a little bit if you want to look at salary. So this is salary by level, and you can see carry. So not surprisingly, the bulk of carry is going to principals and partners, but sometimes associates will get a little amount of carry, but it's not that common. In terms of books, relevant recommendations, Venture Deals by Brad Feld is a great book. Lean Startup is a great book to understand the startup methodology. And then Talking to Humans is a great book on understanding your customer, and a good book to read as an investor or as a founder. What are my thoughts on crowdfunding sites? So the benefits of crowdfunding sites are diversification, right? So as an individual, I can put $50 or $100 into a company, whereas as an angel investor, typically the minimum check size is $25,000. So the benefit is definitely diversification. And for those of us who are learning, it can be very scary to write a $25,000 check. Maybe it's less scary to write a $100 check. So that's the benefit of equity crowdfunding. The drawback is you don't get to meet the founders, right? So you're investing off of a pitch deck, maybe a 2-minute video. And then the drawback is also fees. The fees can be high, between 5 and 20%, depending on the platform. And so overall, I think they're great. I like the ones best where the round is led by a venture capitalist and it says, Lear Hippo is leading this round. And they're opening up a small portion around 2 folks. And that way, you know that a reputable venture capitalist has looked at the deal. So those are kind of my favorite equity crowdfunding sites. How did I go about transitioning from product management into venture capital? A little bit of a circuitous path from product management to venture capital. I started off as an angel investor. So my path was, I wrote my first angel check in 2008. Great year to start being an angel investor. I was a solo angel until 2012. I started 37 Angels in 2013. And we've been lucky enough to have some degree of financial success and kind of good PR. And so in 2015-16, VC started reaching out. That's when I became a venture partner. So it was a little bit of an accidental and circuitous path, but a fun one. How do you pick a secondary investment focus area to diversify your portfolio? So I would say what I like to do is I like to kind of, on a piece of paper, write down for all the basically, if I take these 2 slides, I create a chart. So at the top, I would write expertise, interest, network. And then across the side, I would write stage, sector, geography, founder. And I would fill in the box, right? What is my interest and expertise in those areas? And what you'll notice is a pattern emerging of, so for me, when I was at McKinsey, I did a lot of work in pharmaceuticals. So digital health was a very natural space. And then my path not taken was not going to Amazon to lead professional development for them. And so I'm very passionate about adult learning and adult education. And so future of work, ed tech is very interesting to me. So naturally, that's kind of what emerged. I would encourage those of you who are new to the space to start with one area because you're both learning about an industry and you're learning about venture capital. So to add a second industry on top of that might be a little bit too much to learn all at once. Is CFA an entry criteria for entering into venture capital? Absolutely not. I do not know about websites to purchase stocks in Nigeria, apologies. Yeah, so in terms of starting a career in venture capital, I would really encourage you to read, develop a perspective, and start talking to people in the industry and going to events. Someone's asking me about 37 angels. We have about 100 angels in the network. We've invested in 83 companies, and the portfolio is doing very well. The names of the books are Venture Deals by Brad Feld, Lean Startup by Eric Ries, and Talking to Humans. Venture funds have a dedicated team for fundraising and LPs. Sometimes, if it's a large fund, they will have an investor relations team. If it's a small fund, it's often the founding partner that does all and everything and the one associate they hire. So the smaller the firm, the more likely you will probably need to the smaller the fund, the more likely you're going to do a little bit of investor relations. And then do you need investing experience to get a fundraising job? No. In terms of getting comfortable making investment decisions, some of you might have heard me on a previous webinar, and obviously I teach this on the program, but we talk about the 4 Ps: people, problem, progress, and price. And so that's what we look at. Do they have a great team? Are they solving a large problem that's interesting? Do they have some degree of traction? And are the deal terms fair? And so over time, you start to develop your own internal scorecard. So in terms of my career path, I've had a lot of happy accidents that have turned out to work out well. You mentioned, yeah, so in terms of how specific your strategy should be, so if I were to start with one place to read, if you're interested in developing an investment thesis and you wanted to start with one place to read, I would start with Bessemer Atlas. Bessemer is a venture capital firm, and Atlas is what they've come up with in terms of their thought leadership. And click on their roadmaps. And to me, that level of depth is a good level of depth to get through. And you can read what they think about the space and then start to develop your own perspective. So I'm just looking through additional comments. Scott, if there's one that you particularly
there's actually when I was watching it, there was one. If you could go back to your slides, I would love to go back to the point of view slide that you had. My question here was just, this was something that came to me and I've seen, is that when, I love this idea that when you're making decisions, being more proactive about developing a point of view. Do you have any more thoughts on how you evaluate when you're developing your point of view? In other words, I heard you say, if you look at some companies and you choose ones that you would have invested in and you check on later, you may not be right or wrong, but is there more definite sort of like, I am on the right track, I am going to.
So what I would do is come up with a scorecard for yourself, right? So out of 100 points, what matters to you when you're investing in a company? And so for me, I'm probably 40% people, 30% problem, maybe 20% progress, and then 20% other. I think that adds up to 100 or close to 100. And other for me happens to be impact. So that's the first thing. It's kind of out of 100 points, what matters to you when you're investing? And then the second thing I would do is I would write a paragraph about what good looks like, right? So what does a great team look like? For me, it is deep customer empathy. For me, it is understanding the market they're starting a company in. And so, and I could go more into detail for each of them, but coming up with a scorecard of, again, percentage for each, and then what does good look like for each? And I think that will teach you how to, again, develop that point of view. It's a great question.
And so, on the opposite side, what are some mistakes you've seen people make when they're developing their point of view? Seeing it too heavily on one aspect of it, for example.
Yeah, two mistakes I will call out is that people will often invest too early. So they'll hear 3 pitches and invest in the third one. And I would encourage you to probably hear 50 pitches before you write your first check. Again, the numbers I showed, we look at 2,500 companies a year to invest in 10. It's a very wide funnel. So that's one. And then the second thing I would say is relying too much on progress, right? It's very easy to invest in a company that has $10 million of revenue and, millions of customers. And I think that, I don't know if I said 10,000 or 10 million, 10 million in revenue, millions of customers. It's easy to invest in that company. But as an early stage investor, as an angel investor, we're often looking at companies that have $10,000 to $500,000 in revenue. They might have 3 employees. They're very early stage. And so learning to use other reasons to say yes or no, not just looking at progress.
Great. Did you have more questions you're seeing there, or I can ask some that came in before the webinar as well, if you'd like?
Yeah, go for it.
All right, so one question that came in from Eric, and maybe you touched on a little bit, but just you could evaluate. He said, is there a common trait that you personally look at when you look at founders that you back? Is there a common trait that you find that is?
Yeah, so I have a few, but I'll list 3. So the one I mentioned, which is customer empathy, that is something we absolutely test for. The second one would be what I call kind of organized hustle. And so what I mean by organized hustle is that, founders often, when I'm talking to them, will say, I need introductions to this type of person. And oftentimes I know that type of person. And I see, well, do they follow up with me in an organized and thoughtful way, right? Because you don't want to be aggressive and annoying people, but that kind of balance of like empathetic hustler. And then the last thing I would say is data-driven learner. I want someone who is running fast-failing experiments, who is able to answer. So if I see a number, which is that 7% of your customers are leaving you every month, that's your churn number. Well, why? What are the top 3 reasons? What have you done to improve churn? What's the next feature you're going to add? And so the more they're data-backed learners and are looking at data, not just relying on their gut or just reading stuff online, the more we're likely to invest in them.
Great. So I have a question that just came in. A couple of people asked, and I think it's interesting. They would just love to hear the difference between your upcoming programs. So venture capital and building capital thesis, which are this fall. If you could talk a little bit about the differences in those.
Yeah, so the first course on venture capital, which is also in October versus November, is really about walking through the deal flow process, sourcing, diligence, negotiating term sheets, negotiating valuation, and then a little bit on post-investment activities. And the idea is that you're diligencing real companies. I actually have real companies from the 37 Angels deal flow come in and pitch, and you get to diligence them and ask them questions. So the end result is what it means to go through a deal process, go through a diligence process. Building your VC investment thesis is exactly that. How do you build a point of view or perspective of venture capital? How do you get really smart on ed tech? How do you get really smart on investing in Nigeria, right? There's somebody who asked a question from that area. And so if the end product there is writing an investment thesis.
Right, so the 2 programs would be a nice journey, like a nice total.
It is, and my encouragement is to take the VC course before you take the building your VC investment thesis course. You don't have to, but that would be my recommendation.
Right. Well, we have about a minute left, and as always, there's so much great information here today. As always, Angela, I love working with you. What next? What should they do now? Like, what would you say? What's the first thing they should do? Should they start thinking about their point of view today?
I would write down 3 people that you want to talk to. I would write down 3 events that you want to go to, and then 3 reading resources. And to me, I would start, that's the best way to start developing that point of view. And this is very much an industry where you learn through the apprenticeship model. And so you need to get out there and start exploring.
That's great. Thanks so much. And thank you to all of you for joining Professor Angela Lee, myself at Columbia Executive Education. We wish you a good day, and thank you for joining us at the very center of business.